This channel is for educational purposes only. You and you alone are responsible for your investment decisions.
And as I have been for the last 25 years, I'm watching CNBC trying to come up with new ideas on stock trades. And one of the pros comes out and mentions something, ironically, I've never even heard of. The ticker symbol's SBRA. I know your time's valuable, so I'm going to burn through this information fast. If at any time you're confused, please ask questions in the comments and I will respond. I'm going to take a brief moment, talk about why I selected SBRA, what it is, and how I set up that trade. Then I'm going to go let off some fireworks. SBRA is a real estate investment trust. Essentially, it is a collection of healthcare properties, as it says in the description, that has skilled nursing facilities, there's some hospitals, senior care. But the theme of it is, in a REIT, to qualify for a REIT, you have to actually pay out a certain percentage of your income in the form of a dividend. I don't always get into REITs, but I have in the past, and it depends on where the market is as a particular step. My belief, markets run an awful lot in 2024. Okay, the Mag 7 had kicked some serious crazy butt, and Tesla in particular has made me an incredible amount of money. But that excitement doesn't last forever. I'm not saying Tesla won't go higher than it is right now, but what I am saying is I want to take some of those profits, right, because it's a huge portion of my portfolio right now, and I'm going to shift them into more conservative things that I feel will do well. Here's my bull case for this REIT. This REIT's been paying 30 cents a quarter since 2020. The current dividend yield 7%. And what I really liked, Q3 news said there was occupancy gains. That tells me there's more profit coming in. 32% growth projected next year. Those are the pros coming up with that. Estimated earnings are going up, not down. There is some risk though. If the earnings don't cover the dividend, then they could cut the dividend and that would cause the stock to go down. Another concern would be the 52-week range is about 13 to 20, and it's currently trading above 17, so it's at the higher end of that range. The other thing is they've missed a few earnings reports over the last few quarters, and so that to me is a concern. Stocks are driven by earnings, and if earnings aren't what they expect, then stocks typically go down. But I think the dividend itself at 7% will have a floor that will help support this REIT. So I'm not overly concerned, and with options, it opens up a whole nother world to be able to profit from this. There's 3 trades I did against that REIT. And the first was I bought 500 shares. That cost me $8,650. I expect to gain about $100 on that share appreciation and $300 in dividends over the course of this trade. The second thing I did, since I own 500 shares, I'm allowed to sell 5 covered calls over the top of that. I was able to get $1 premium for each one of those, so $500 total. And then finally, I obligated myself to buy another 500 shares, but at a price significantly lower than the current trading price, which is $15 a share. And I got $125 for that. So essentially, it was the $400 for buying the stock and the dividend, $500 for the calls, and $125 for the puts. So buying a stock or REIT is relatively easy. You just put a limit order in, you put your price, you collect the shares, and if it goes up in value, then you make money. Options is a whole other world. If you're not familiar with that, if my explanation of how I'm doing this trade is confusing, like I said, put the comments in there. I'm going to go let some fireworks off. I'm going to keep posting this in this shared Google spreadsheet, so please track that. Maybe it gives you some investment ideas. And over time, you can see how well this method works. With that, Happy New Year. Cheers. May 2025 be exceptionally well in the investment world. Take care and God bless.